you talk about low risk opportunities and sending out kind of across multiple markets a low risk trade. So how do you kind of find low risk opportunities for your clients?
Okay, so as I say, number one rule, trend following. I only ever buy in a bull trend. I only ever sell in a bear trend. So I'm looking for support levels in a bull trend. Dead simple. I use Fibonacci. I use slow stochastics. So if the slow stochastics oversold in a bull trend, that's making me think, hang on, maybe I need to start looking at getting in. Trend lines, moving averages, and all the things that you can do with moving averages. They can work as support levels, moving average crossovers, all that kind of thing. That's pretty much it, actually. I think that's all the indicators that I have on my chart. Very simple. I look at multiple time frames, like everyone does: hour, 4 hour, daily, and weekly, and even monthly. I need to remind myself to look at the monthly chart, but it's something that you really should focus on. You really need to see the bigger picture. When you were just talking about the yen, if you look at a lot of yen pairs right now, you go back 3 or 4 decades, we've had a major breakdown in the yen. And to me, from a technical perspective, it looks like the yen's going to collapse. And it has gone down significantly from where I said it had broken. And people were like, can it really keep going? The Bank of Japan won't let it fall that far. Well, it already has started. I mean, I don't know. I don't know what the trigger could be, but it looks like the yen's in for a lot further to go when you look at a monthly chart. So that's kind of it. Yeah, and because I have my processes so well rehearsed, I've been doing it for so long, I can skim through 25, 30 markets pretty quickly. Problem at the moment is that there's so many Forex pairs that are trading in longer term sideways trends, and I really struggle with that. I think most people struggle with sideways. It's so much easier to trade a bull trend or a bear trend.
Yeah. You mentioned the yen, and I think when I started working with a mentor this year, he was a very big macro guy and big on bullish yen, which macro would make sense, right? But I think sometimes the beauty in technical analysis is it does kind of write out all the opinions or quiet all the opinions of everyone and just watches price action. And yeah, when yen hit, I don't know what it was, 155 or something, and then I heard people calling for 160 dollar yen. And I was thinking, oh no, this can't be the way it works. I think this is the macro world. And then they just kept selling yen. And it was one of those times where it's just like, exactly. You have to listen to price. It's just gonna, that's just the way it's going. Right?
Yeah, as I say, you got to keep your thoughts on the macro. But like beginning of the year when inflation started strengthening in the UK, in the US, and people were like, oh, there won't be a rate cut. Rates might even have to go higher. Well, if you just stuck with the trend, the trend for interest rates was the trend was it was going to reverse, and the dollar was weakening, and gold was continuing to go up, and the stock markets. I mean, I think the stock markets are insane. I don't know what they're doing up here, but you just can't argue with it. They're going up. Yeah. Just don't sell it.
Yeah. But it can be such an enticing case for someone that's new, because I guess when you're selling against the majority, it's kind of got that feeling of, I know something that the market doesn't know. And even if it's very unlikely you do, but even if you do, it doesn't matter. It's that classic market can stay irrational longer than you can stay solvent, and you're just going to lose your money. I know, because I tried to short equities, and now I almost have a golden rule to never short equities, because I think they go up. I think it's 7 out of 8 years equities go up or something crazy like that. So
I can't tell you how much money I've lost from trying to pick the top in the stock markets over the years. I stopped doing it a long time ago, but I just kept doing it. I just thought it's too expensive. It's too expensive. It's gone up so much. And this is one reason why I'm a trend follower now, because I've lost so much money by trying to trade against it. Yeah, it just doesn't work.
How do you identify, say, a bull trend or a bear trend, and what kind of time frames do you use to do that?
For me, the time frame I think that I rely on most is the 4 hour. That works for me because I'm looking for trades where I can risk, as I say, about 25, 30 pips, try and make 50, 60, 80, 90 pips. So that suits that time frame. It does at the moment because markets are not that volatile. Sometimes the euro, US dollar will move 30, 40 pips in a day. I mean, it's appalling. It's so difficult to make money now. I remember the days when it would always move 100 pips. So you could easily do an intraday trade, nick 60 pips and not even catch the high and the low. You didn't need to. Nowadays, in order to do what I do, you have to run a lot of positions overnight. So anyway, for that reason, that the 4-hour time frame works for me. If things got more volatile, and I hope they do soon, then I would probably focus more on the 1-hour chart. Because if you're moving 100 pips a day instead of 50 pips a day, then you only need your fib levels going back across an hourly chart in order to find trades where you can risk 25 to make 50. So basically, right now, the 4-hour chart is the one I go to.
And on the 4-hour chart, are there any specific moving averages you use to say when this crosses this, it's a bull trend, or price is above this and therefore it's a bull trend, or how do you?
I have a very standard chart set up. So I have 50, 100, 200, and 500 moving averages, and that's because I look at 30 markets. So I have to have a one size fits all for every market. If I was to advise someone who's starting to trade, most traders shouldn't really be looking at more than 3, 4, 5 markets, and probably only really trading 3 at a time. It's just not necessary. On that note, actually, I would say focus on a small number of markets, but to practice your technical analysis while you're sitting there doing nothing, look at as many markets as you can, throw your trend lines and your moving averages and your Fibonacci's on there, and just get used to looking at the price action and how trend lines work. But actually trading, you should focus on a smaller number. Now, because I look at so many markets, as I say, I need a one size fits all, so that's what I use. But if I was focusing on gold and the euro US dollar, for example, I would probably try and fine tune my moving averages a little bit better to the time frames that I use, so that I would have the moving average mapping the price action a little bit closer.
Right. And do you wait for say the 100 or 50-day moving average to cross over a different moving average to know we're in a bull trend, or you use kind of price relative to the moving averages? Or
I don't rely on moving averages as a trigger, as a signal so much. I would use them as a confirmation because they're a lagging indicator. So I'm trying to get in before the moving averages turn. So for that reason, I think Fibonacci's are amazing. In fact, if there was only one tool that I could use, I think it would probably be Fibonacci. As long as you can get a trend, a sustainable trend, a prevailing trend, then using Fibonacci's to identify support levels. I'm looking for areas of confluence, so I'm looking for Fibonacci's to combine with moving averages and trend lines and candle patterns and candle formations. But if I could only use one thing, I don't know why they work so well. They just have this spooky. I think it just shows there's such a mathematical element to the markets.
Yeah, that was my next question, actually. Basically, if you had to pick a kind of ride or die technical analysis tool, what would it be? And right, it sounds like Fibonacci, but
good question.
I watched your demo with Etienne Crete, where you kind of went through how you drill down using Fibonacci, which is quite different to a lot of people. So can you explain a little bit how kind of you start from much higher time frames and then you go all the way down to find multiple confluences?
Yeah, simple. I don't know if I assume other people do this. I don't know, but I kind of figured this one out for myself. So I will go back as far as I can. If you really, really want to do what I'm saying properly, you have to go back a long way. So, for example, if I was looking at gold bottomed around 20 years ago at something like $266, I think it was, and we've gone up ever since. So I would only do this if I was expecting a big correction to the downside. I would take my swing low there and swing high to where we are now, or close, whatever the all-time high for gold is, 240, whatever, $2,450, something like that. And then what I'm looking for is a swing low around the 61.8 once I put those Fibonacci levels on there. And you get it so often. It's really weird. When you get that, then I put the Fib levels on, and then I'll look at the 38.2 and I'll try and find another swing low around there. And I'll put my third set of fibs on there, and I might even go to the 23.6. And I'll just keep doing that. I'll just keep breaking it down. And this gives you a fantastic roadmap for whatever market you're trading, of just levels. And if they tie in with the price action, which obviously you can see immediately, then I think to myself, okay, these are a reliable set of Fibonacci levels. And then if they also tie in with my moving averages and trend lines, then I've got trading levels in front of me. Dead simple. Now, sometimes they don't all line up. And that tells me, okay, this move isn't over. We're going to probably keep going before we get a correction, because the price is not lining up with the fib levels. So there's further to go.